The European Central Bank takes center stage today, with markets overwhelmingly expecting policymakers to deliver a 25 basis point rate hike that would lift the deposit rate to 2.25%. The move has been heavily telegraphed in recent weeks and is now almost entirely priced in, meaning the real event risk lies not in the decision itself, but in what President Christine Lagarde says about the path ahead. The backdrop for the ECB has become increasingly complicated. On the one hand, inflation risks have reemerged, driven by higher energy prices linked to the ongoing conflict in the Middle East. Eurozone headline inflation has accelerated back above target, while measures of core inflation and services inflation have also moved higher, raising concerns that what began as an energy shock could start feeding into broader price pressures. On the other hand, the growth outlook has clearly deteriorated. The Eurozone economy contracted in the first quarter. Business surveys have softened, and consumers are showing signs of becoming more cautious as higher energy costs weigh on confidence and spending. This has left the ECB trying to strike a delicate balance between preserving its inflation fighting credibility and avoiding a policy mistake that could unnecessarily deepen an already fragile slowdown. As a result, many analysts view today's move as an insurance hike rather than the beginning of a full blown tightening cycle. The ECB appears keen to get ahead of any potential second round inflation effects before they become entrenched, while maintaining the flexibility to pause or even reverse course should inflation pressures subside and growth conditions worsen. For markets, the key question is what comes next. If Lagarde emphasizes a data dependent meeting by meeting approach and avoids signaling any urgency around additional tightening, investors may interpret today's move as largely one and done, which could limit gains in the euro and offer some relief to European equities. However, if the ECB maintains a clear tightening bias and leaves the door open to another hike as early as July, the euro could strengthen further while bond yields move higher and rate-sensitive sectors of the equity market come under renewed pressure. If history is any guide, Lagarde is unlikely to pre-commit to a specific path for rates. The ECB has generally favored preserving optionality during periods of heightened uncertainty, suggesting today's move is more likely to be framed as a precautionary step aimed at safeguarding inflation credibility rather than the start of an aggressive tightening cycle. That said, policymakers will likely keep the door open to further action should energy-driven inflation pressures prove more persistent or evidence of second-round effects begin to emerge. That's all for now.